everybody. Welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Matt McCall, president of the Penn Financial Group. Matt, how you doing? Good to see you again.
Good to see you, Mike.
So what's going on? You've been here several times. I know you're a long-time commodity bull. Things now looking a little bit under pressure, I would say, liquidation in commodity markets. What's your view now?
Well, short term, it does not look good. I mean, there's no way when you're watching gold fall through major support levels almost 3 consecutive days in a row.
And I want to talk about that.
Yeah. I mean, overall commodities, I mean, the only commodity that's really hanging on that still looks pretty strong to me is oil.
Right.
Even though we are concerned about its global economic slowdown, we still have oil holding on near that triple-digit level.
Well, you saw some crazy things recently, like the Iranian closure of the Straits of Hormuz. I mean, even though it was a one-day thing for military exercises, still, that's a little bit scary. If that happens, I think oil could really take off, right?
And you know, that could happen. I mean, and that's something that's always weighing in the back of your mind when it comes to oil, and that builds in a premium. That could put a couple dollars into the contract of oil. I like oil because I think even though we have a lot of rocky times ahead, I still think we're going to have some growth, global economy. We're not bringing a lot of oil back online. So, you know, I think demand's going to outstrip supply. So we will keep up above the $90 level. Anytime you pull back to the high 80s, low 90s, I think it's a buying opportunity. On the upper end of the range, about 105. So we probably stay in this trading range. But I think that will hold up where we look at the ags, you look at anything else out there, all the metals, they're dropping, falling through support. So that's one area I'm going to stay away from right now.
Yeah, I agree with you on the oil. I think just from the geopolitical standpoint and everything that's happening with Iran, will there be a strike on Iranian nuclear facilities? Will they try to block off the Straits of Hormuz? And if they did that, I mean, you know, name a price on oil. But I want to talk about gold. Gold is interesting because for the last 3 or almost 4 years now, going back to 2008, when we saw all the extraordinary measures by the Fed and other central banks, and there was a lot of people out there who were gold bulls who argued, oh, this is printing money, this is the debasement of the currency, you have to buy gold because it's an alternative currency. Yet, if you look at the dollar, and if you look at the dollar index over that period of time, very interesting, it's really been going higher. Okay, so does this really throw water on this whole money printing argument? And if so, is gold kind of waking up to, hey, it really wasn't inflationary?
Well, let's talk about gold first, then we'll touch on the dollar. When I look at gold, it's still my largest holding, even though it's taken a beating recently. We started scaling at $600 an ounce and scaled all the way up. I still like gold longer term. I'll tell you why. Look at two things can happen. One, look at the Europe situation. If things fall apart, I think gold's going to be that safe haven. I think people will rush into the dollar and gold. I think they can both move in tandem.
It's not really happening. We're not seeing gold. I mean, the European situation is deteriorating by the day, isn't it?
I know, but we're not into that panic mode, I don't believe yet. If we get into the panic mode where the EU falls apart, we see one nation pull out, if they say, you know what, I'm done with it, that could lead to basically the end of the euro, end of the EU. If that happens, that's kind of the worst case scenario for the markets.
But wouldn't that be bullish for the dollar? Wouldn't that be?
I think that's the one situation where the dollar and gold will move in tandem because you're going to have money obviously run out of the euro, which will not be there anymore, running into the greenback. At the same time, you're going to have people that are thinking the entire world's falling apart, that maybe America's next, that with their deficit issues, that they would go into gold as well. So we've seen several months over the last year where gold and dollar have moved in tandem. Historically, they do not, but I think that this is one situation where it could. The other situation is things get taken care of in Europe, and the euro finds some footing, moves higher, and the dollar comes back down. That, again, is good for gold longer term. So in the short term, though, we're breaking through $1,600 an ounce. We could fall down to maybe $1,400 an ounce. Probably get a big pop at that time just because people are jumping back in.
So basically, gold has gone from an inflation hedge to a risk-on, risk-off trade, and now it's more of a risk-on asset. If you want to play the risk-on direction, you buy gold. If it's a risk-off environment, you sell gold, and that seems like what's happening right now. The dollar, let's talk about that a little bit. Going back to what I said a few minutes ago, that despite everything that has been done by central banks over the last almost 4 years, it goes back to 2008, we're almost in 2012, the dollar has slowly but surely been trending higher. If you look at the dollar index, if you look at the trough that it put in, the low that it put in 2008, right around pre-Lehman, and where it is now, it's up by several percentage points. And that comes even as we've seen Fed balance sheet go from something like 800 billion to almost 3 trillion. ECB's balance sheet topping the Fed's balance sheet right now. What does it say? I mean, and also does this say the dollar now is in for a longer term ascent?
Well, I think it tells me that it's the best of the worst. I mean, you look at all the currencies out there. What currency do you really want to own? People are rushing into the yen and the Swiss franc. Well, the Swiss National Bank jumped in. That ended this whole Swiss run. The Japanese yen, the Bank of Japan tried several times and knocked that down. Not too successful.
Half-heartedly, I would say. Not like the Swiss.
Exactly. Yeah, not too successful. I still own a lot of yen right now. Where you look at all the currencies, U.S. dollar is really the best of the best. And it's a safe haven, too. We have a lot of uncertainty out there in the world right now, so people are rushing into the dollar. And keep in mind, before we kind of built this base over the last 3 years, we were down basically 10 straight years in the U.S. dollar index. I mean, this was just one of the ugliest charts in the market coming down. So I think we've come to the point where, yes, people are going to be moving money into the dollar. And why not? I went long the U.S. dollar a week and a half ago. First time, I could say, probably ever, that I've ever moved into the U.S. dollar. I've been a U.S. dollar bear forever.
I know that.
I really believe now that U.S. dollar does have the momentum to move higher. I also believe that if you look at the grand scheme of things, if things get worse, where are people rushing? To safety. They're going to U.S. bonds. They're going into U.S. dollar. So I do believe the U.S. dollar is somewhere to hedge a portfolio too. When the market's down big, down triple digits on the Dow, what's up? The U.S. dollar has been up recently. It was gold for years that people rush into. Now basically that currency alternative that was gold is now back to a real currency, being the U.S. dollar.
So this, I guess, would factor into your shorter or medium-term view of commodities under pressure, maybe portfolio shifts out of commodities into safer assets. But it sounds like you still have a core holding of commodities, and you're going to be using weakness, over time as it develops to accumulate more. Is that correct?
Yeah, I mean, when I think about the commodities, the ones I still like are agriculture. You still have demand for that. There's a lot of metals, the base metals. You still have demand for. A big issue, which a lot of people have been ignoring because of Europe, is China. China's been kind of slowing down quietly, and it's kind of the second headline behind Europe right now. But we've seen numbers almost every day. The Shanghai index at one point, I think, was down 9 out of 10 days. It's getting hit really hard, hitting close to a 3-year low. So as China slows down, demand for all of these goods are dropping at the same time. China slows down to 7.5%, 8% growth. It's still the best you're going to find around the world in my mind. So we're going to come to realization that 7.5%, 8% is good. The market's going to get priced down as it is in China. And then we're going to find a base and to find a bottom for commodities. At that time, whether it's a month from now or 6 months from now, yes, I'm going to go back into commodities. And I think you're going to have a great bargain price. But when you have, I don't want to call it a bubble, but when you have such a run-up that we had in commodities, as fast as you go up, you come down even faster. And we're seeing that right now in commodities.
We've seen that. We saw that in 2008, where a lot of these markets reversed entirely the moves that had built up, in the years prior. China is interesting because recently, last month, we saw the Chinese government, the Bank of China, for the first time, reduce bank reserve requirements. So kind of like a subtle sign that it was shifting policy that had been in place for the prior year and a half, where they were tightening, they wanted to slow things down. You're right, the Chinese market looks under pressure. Their economy is definitely slowing down. It would seem that China now maybe taking the foot off the brakes. That's the first sign, right?
It's the first sign telling me that maybe they're a little concerned as well.
Yeah.
That things are slowing down a little bit faster than they anticipated. And that ties directly to commodities. I think even more than the fact that the U.S. dollar tied to commodities, I think China's more important. Because, you have the currency aspect, but still, if you have basically the largest user of commodities in China suddenly slow down, what happens? When your demand slows that dramatically and supply's been ramping up because to meet the increasing demand from China and the emerging markets, you all of a sudden have the equilibrium switch to the other side. That's a big reason I think commodities are getting hit. But China's not over. Is it bubble kind of bursting a bit? Absolutely. But it's not the end of the world here for China. Policy, I think they're smarter than the United States many times with the way they work in their policy.
Well, they don't have to deal with a Congress. That's
a big reason, yes.
That makes them smarter.
Yeah, when you're kind of a communist country, you can make the decisions that's best for the country, and it's actually working for them. I think China will figure it out in the next 12 months. Sometime in 2012, they'll bottom out. At the same time, you're going to look at the charts, they will bottom the same time the commodities bottom. I think as soon as they turn around, you'll see commodities turn around right with China. So if you want to know when to get into commodities, watch the chart on China.
Yeah, I agree. That's been the correlation there. So big picture now, commodities as an asset class. That theme, that idea is not going away, is it?
I don't think long term. I think you have a rocky road, and if you're able to be nimble and get back in 6 months, I think you can lighten your exposure to commodities right now. And if you want to even drill down further, a lot of the commodity stocks are getting hit even harder. So if you really truly believe in the ags and energy going forward, wait for some of these stocks to pull back a little bit more. You're going to get at bargain prices. Many energy stocks now are trading at PEs at 6 and 7, well below historical values. Let them pull back even more. Yeah, so they are cheap, but I think they can get cheaper. And then keep an eye on, I think, not natural gas itself, but this fracking that's going on here in the States. We're seeing a lot of deals with liquefied natural gas. This is going to be big, and there's a lot of companies out there that are able to increase the amount that they're getting out.
But you don't think there's a political resistance to this? We're starting to see now, hey, it contaminates groundwater, this sort of stuff.
Well, I saw there's a big study came out of Wyoming that said that, that happened. It depends who's in office. If Mr. Green Jeans Obama's in there, yeah, he'll probably stop fracking and lose another 1 million jobs. But if we get the GOP in there, what the heck do they care? They're going to drill.
Right.
So I think we're going to see it happen.
No Mr. Green Jeans. No. All right, Matt McCall, thanks very much.
Thanks,
Great
Mike.
to see you. That's it for now, folks. See you next time. This is Mike Norman. Bye-bye.